Hey everyone, and welcome. Today we are sinking our teeth into one of the biggest, most profitable companies on the planet, Apple. You know it, you've probably owned some of its products. It is an absolute titan. But for us as investors, the real question is always about the price. So today, we're going to tear down the business, look at the numbers, and figure out if Apple stock is a smart buy right now.
All right, let's not waste any time. Let's get right to the big question on everyone's mind. With the stock floating around $250 a share, is Apple a good investment for the long haul at this very moment? We're going to dig into the business, the financials, the whole shebang to find a clear answer.
And boom, right out of the gate, here's the core of the whole story. You've got the market price, what you pay on your brokerage app, at $250. But then, a deep dive valuation, which we're about to get into, says its intrinsic value, what the company is actually worth based on its fundamentals, is closer to $206. That's a premium of about 20%. So the question is, why? Why the gap? And is it justified?
To really get Apple, you first have to understand its defenses. We're talking about its competitive moat. It's this idea of the structural advantages a company has that protects it from rivals. And trust me, Apple isn't just a company that sells cool gadgets. It's a fortress. So let's take a look at the walls holding this thing up.
Now, here's the really cool part. It's not just these 5 pillars on their own. It's how they all work together. It's like a chain reaction. The iconic brand lets them charge a premium. That premium product pulls you into their ecosystem. And once you're in, it's really hard to leave, right? Because the software integration between your iPhone, your Mac, your watch, it's just so seamless. And this whole thing is built on their ridiculous scale and supported by a huge army of developers, making the platform better every single day. It's a flywheel that just keeps spinning faster and faster.
So this isn't your boring old SWOT analysis from business class. This one is weighted, which means we're not just listing things, we're showing how much they actually matter. And just look at this. The core strengths, their brand and cash flow, are weighted at 30 and 20%. They completely dwarf potential threats like government regulation. This just hammers home how overwhelmingly powerful the company's core advantages are.
Okay, so the fortress walls are high, they're thick, we get it. But what about the treasure inside? Let's talk money. We're going to shift over to the financials and see how all that competitive strength translates into raw, honestly just staggering numbers.
Just take a second and let this number sink in. $123 billion. That's the free cash flow Apple generated in the last year. That's the actual cash left in the bank after running the entire global operation. I mean, that is an almost unimaginable amount of firepower. We're talking about a cash pile that rivals the economies of entire countries.
And if you thought that was impressive, check this out. A return on invested capital, or ROIC, of over 50%. For a company that actually makes physical stuff, that is just extraordinary. You normally only see numbers like this from pure software companies that don't have inventory or factories. What this tells you is that Apple's management is unbelievably efficient at turning $1 of capital into profit.
And it's not like they're slowing down either. The growth story here is just as powerful. Over the last 5 years, their bottom line profit has grown by over $53 billion. They've added that much profit. This isn't some one-hit wonder. This is a story of consistent, powerful, relentless growth, year in and year out.
Okay, so let's recap. We've established Apple is a phenomenal business, an absolute beast. But, and this is a huge but for us as investors, that is only half of the equation. Now we have to talk about valuation. What is one share of this incredible company actually worth? Well, this analysis comes at it from 2 different angles. First, you've got a discounted cash flow, or DCF, which is a fancy way of looking at all the cash the business is expected to generate in the future. That model spits out about $198 a share. Then you've got something called market earnings value, which looks at what the market usually pays for this level of earnings. That gives us $215. So you blend them together, and you get a pretty solid conservative estimate of $206 per share.
But of course, nobody has a crystal ball. The future can play out in a lot of different ways. So in a bear case, if growth slows down, maybe the value is closer to 165. Our base case, the most likely outcome, is that 206 number. But in a bullish, everything goes right scenario, you could argue it's worth up to 265. And here's the key takeaway. At today's price of 250, you are essentially betting on a near-perfect bull case outcome.
All right, enough theory. Let's make this practical. Let's turn all this analysis into an actual game plan. What do these valuation numbers mean for you if you're thinking about putting your hard-earned money into Apple stock today?
And this quote right here, It just nails it. This is the whole point. You can find the best company in the world, but if you overpay for it, your returns are going to be disappointing. The price you pay is just as critical as the quality of the business you're buying.
So, what kind of return do you want to make? This table lays it all out for you, assuming a 16-year holding period. If you're happy with a 5% annual return, well, then buying around 240 is okay. But if your goal is more ambitious, say a 10% return every year, you need to be patient and wait for the price to drop all the way to 175. You see how your entry price literally dictates your future success?
Okay, let's focus on a 9% return. That's a pretty solid target. What's fascinating here is how your timeline changes the math. If you're only planning to hold the stock for 5 years, you could probably pay up to $225. But for that true long-term 16-year-old, your ideal buy price drops down to $190. The longer your time horizon, the more disciplined you have to be about your starting price. It matters more, not less.
All right, let's bring it all home. We've looked at the business, the finances, the valuation. We've covered a ton of ground. So what's the final, crucial takeaway from this whole deep dive?
Here's the whole story in a nutshell. First, Apple is an absolutely extraordinary business. Top tier. Its moat is legendary. Second, it's a financial juggernaut, printing over $120 billion in cash. Third, and this is the big one, at $250, it's trading significantly above its estimated fair value of around $206. Which brings us to the bottom line. For a long-term investor who wants to make a solid 9% return, the real target buy price needs to be much closer to $190.
And that leaves us with this final, really provocative question. There's absolutely no doubt that Apple is a great company. But the most important question for you, the investor, is this. Is it a great stock to buy at today's price? And the answer, as we've seen, really depends on the future returns you're aiming for. I really hope this breakdown was helpful and gave you a lot to think about. Now, I want to hear from you. What company should we put under the microscope next for a deep dive analysis like this one? Drop a comment below and let me know. Thanks for watching.